The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, folks. My name is John Needham. I'll be your host for the day. We have some people down in the lands of the Shaky Isles over there, and we also have some folks down here in Australia. So good morning to you. 12:30, good afternoon to the folks in New Zealand. It's a beautiful day over here on the Gold Coast. It's middle of winter, but it's very, very much warmer than I've been used to, and the Pacific Ocean is looking startlingly brilliant. I've got quite a bit of stuff to talk to you about today. We've still got people coming in, so we won't rush them too much. We'll give them the courtesy perhaps of another 2 minutes. We've got quite a big crowd today, and they'll just take a few minutes to get in and get connected. So I want to say hello to you and let you know that we've got some new and exciting stuff for you today. I'm going to, in particular, show you how you could have dealt with the sort of turmoil around the Memorial Day holiday in the US dollar index and in the E-mini. And I'm going to show you that that was a difficult time. What we're looking at now, the screen you're looking at, is the standard Danielcode screen with the fast stochastic, the 533, the slow stochastic, the 1433, and our proprietary CCI momentum indicator. The stochastics that we use, you'll see that at the beginning they have DC stochastic. They're Danielcode stochastics, and they're a very special type of stochastic. The number one cause of error in all studies is inside bars. So I've created these special studies that ignore inside bars for their purpose of their creation. And when they get an outside bar, they deal with it by substituting the value of the average of the last 2 or 3 bars. And you'll find that these stochastic indicators are very much better than the standard ones, particularly if you're doing any short-term trading. Your stochastics will be significantly wrong when you get an inside bar. So if any of you, all members, all Danielcode members, get our proprietary trading tools, and if you don't have these DC stochastics and the CCI momentum indicator, you can send an email to Terry at support@thedanielcode.com, and he'll be happy to arrange to switch that on. We've now gone about 4 minutes past our start time, so we should, everyone should be here, and we can now get involved in the serious stuff of the day. It's pretty interesting. I usually look at charts either from our GMAG suite or from our new Fractalian suite of signals, which is pretty amazing. And I don't often look at the just the standard Danielcode charts anymore, because we've progressed so much since then. But it's sort of looking like looking at someone nude, someone that it's very inappropriate to look at. I look at the thing and I think, crikey. I don't know how you blokes are trading without newer stuff, but if any of you are interested, you can talk to Terry about the GMAG, and you can come along to a tutorial, and I'll teach you this new Fractalian trading system, which is quite extraordinary in my view, because it doesn't use price to create its signals, and interestingly, and I guess this is the novel part of it, it doesn't use stochastics either. Now, what a stochastic is, it's a study that's telling you where price is today relative to price X periods ago, and it's very much a standard tool of all traders. But with the Fractalian, I've created a way that the market will create its buy and sell signals only from time. It's looking at fractals, that's why it's called Fractalian. It's looking at fractals of the dominant Danielcode time signals, and it's creating the signals based purely on time and nothing else. And that's a very, very interesting and quite different view. That should be better. I think you can see those screens all right now. Yes, Terry says he can see it. So that's interesting. You can come to a tutorial and I'll teach you all about that. We just had a Fractalian, our first ever Fractalian webinar in Las Vegas last month. End of April, actually. I guess another month has gone by. We're into June. And it was pretty exciting for folks. So we want to thank Fluffy Cuffs, one of our members, who came up with the word Fractalian. I was calling it Zero Zen, which is one of the studies that runs it. But in fact, we call that now Fractalian, that just creates signals from time. I'm not aware that anyone else has ever done this, so it's pretty exciting. It does give you some rare insights into markets. So let's get on with what I want to teach you today, which is how to handle double hooks. By that, I'm referring to these two bars. This is the ES or E mini chart, and we had the big key reversal bar on May the 22nd, which set up the first hook, and then here's the second hook on May 28th, and that certainly confused a lot of people because from this chart that you're looking at here, which is the basic Danielcode trading chart, there isn't a sell signal on that day of 0528. And there wasn't a sell signal on our GMAG, our more sophisticated program, and there wasn't even a signal on the Fractalian. There was a suggestion of a signal, but you needed to do some other things to see that signal, and I'm going to show you that here. While I've got your attention, I know that some of you can't stay all day, and while I've got your attention, I wanted to just show you a couple of things. If you've been reading the front page of our website, you will notice that I have been talking a lot about the fourth seal, and I was unable to show you the fourth seal because our I'm just waiting for this to change so you can see it. I don't think you can see my page yet. Okay, need to click a button or something here and get this page to change. It has now. I'm sorry for that delay. This is the fourth seal page. A lot of you have had a free trial of this. It's quite an extraordinary thing. This is something I invented about, or I started working on it at least probably 20 years ago. And I only perfected it in the last few years, and I've been teaching it at Danielcode tutorials for a couple of years. And what this is a forecasting tool that forecasts market turns sometimes weeks and months in advance, and it's quite extraordinary. It's just so accurate and amazing. It's very time-consuming and difficult to create these charts and these reports. And as you can see, there's quite a lot of detail on them. This first panel you're looking at is the S&P. This is the index. And underneath it, it has the notes going back to, you can read that. It says from 2 weeks ago. The S&P is also pointing towards the top in the making. We're at fourth seal resistance, have a lot of cycles, etc., etc. Now, this was up. This has been forecasting this little high that we've got at the moment, which might turn into a more important high, for about 3 or 4 weeks. This is a 6-day chart, which is the Danielcode timing chart. Each bar on this chart is 6 trading days. And if you don't understand why that is, I suggest that you click on the Articles tab at the top of this website and go to the 2 articles called Masterclass. One is Masterclass 1, it's about time, and the other one is called Masterclass 2, Trading Gold, or Timing Gold rather, and that's specifically on gold. The other one is largely on the indices, but these fourth seal support and resistance levels work on all markets. They're quite extraordinary. And if you haven't already seen them and had a free trial, I suggest you email Terry at support at the Danielcode, and he will give you a free trial. If we just have a look at these as we stroll through, you'll see why I'm so excited about them. This is the DAX. We've had a fairly big view of the DAX for some time that it was going to make its top. You'll see from this chart that there were 3 Danielcode timing cycles expiring in that week, the 44, the 62, 59. They're all the standard Danielcode timing cycles, and that the market was at Danielcode resistance on that fourth seal. In fact, for the week before the turn, it closed exactly on the red line. And you'll see in here that we give you not only the date but the exact numbers at which these markets will turn. And it's very, very accurate. It's staggering. I've been in this business for an awfully long time, and I am constantly amazed by this. The next chart you're seeing is the DX. That's the US dollar index. This turn we've had has been forecast for months, literally a couple of months. We've seen it tracking up that red line at the top before it made its turn, and we were simply waiting for that 59 cycle to bite, and when it did, that forced the turn in the US dollar index. Here's the same thing. This is gold, which has been pretty dramatic. As you can see, it turned right on its 59 cycle before it had the big sell-off. It dumped down, it came back up, it ran into another 59 cycle, which forced it back down. We then had a 62 and a 59 cycle at the first retest of the low, followed by a 44 cycle, which is gold's number. Incidentally, 44 is the vibration for gold, and that's given it support all along there. So even with the drama of that sort of huge crash bar in gold, it hasn't specifically found its Danielcode numbers yet. We expect it will do that. The drama of that sell-off has pushed it either early or late on those numbers, but the time cycles have been absolutely perfect. And you can see the comments that are put up twice a week. Now, that twice a week, incidentally, is twice a week when there's something new and worthwhile to report. I've had one of our people write and say, oh, look, you've missed a few updates. In fact, we haven't missed updates. These charts are updated every weekend. And then in the midweek, if there's something new to report, you get an update of that also. But this program is predominantly running on these 6-day charts, so there's not always something, excuse me, to report an update. The chart you're looking at now is oil. You can see it's a very complex chart, but you can equally see, excuse me, that every market, every turn in this market has come at a Danielcode fourth seal, and that is where time and price are squared. In other words, that's where a market has reached a known Danielcode price level and a known Danielcode time level, and that's what those red lines are showing you. They're support and resistance, but when they're combined with a Danielcode time cycle, a turn is almost irresistible. So, there's a very, very complex market there that we've been trading and enjoying, and I really don't know how you trade without knowing these things in advance, which is what the fourth seal shows you. One of the problems with the fourth seal is it's been relatively expensive for us, for the Danielcode people. We're not traditionally, we're not all millionaire hedge fund managers. This is a business that I've set up for the benefit of private traders, and cost is always a concern. So what we're going to do with this fourth seal to make it more accessible to you is we're going to let you buy one or more markets alone, which will be a fraction of the $1,200 that it presently costs for all markets. A lot of people have written to me saying, look, I really love this stuff and it would be a great help to me, but it's just too much money. So we're going to break that up and let you have access to the fourth seal, and you can just buy one or two or three or four or however many markets you want. at a very, very much reduced price. And that's important that we continue to make these products. They're very expensive to produce, but it's important that we continue to make them available to you. Let me now take you to the front page. This is our home page, which you should read when you get a chance, and you'll see from here that if you read through this trading turns thing, that we're going to go and look at those particular turns in a moment. The fourth seal was forecasting all these things, and even said in regard to one of them, if it has a break above the high, it won't be a very significant break. It'll just break it in reverse. So this fourth seal stuff is quite amazing, and I do recommend it to you. Okay, let's move on now. This is the ES, and we're going to talk about how we traded through this period around the Memorial Day holiday. But while I've got you all here, I wanted to show you our new product, which is called a Fract Zen. This is a shorter term trading system. It's a derivative of the X charts that I was working on for years. Some of you know about that. And I could never get the volatility switch on it to work quickly enough. So this is, and I still haven't, and one day I will, and it'll be very exciting. But this is a slightly detuned version of the X charts. We've been looking at this stuff now for about 2 years, and it's terribly interesting because these individual bars are running at about 33, 34 ticks, and as I'll show you, until the last couple of days, this sell trade in the indices has not really returned any money because of the large risk we have on entry, the large stops, which keeps our volume of trading down fairly small. This is this new Fract Zen, which is a shorter period time chart. It is based on time cycles, and it self-adjusts every 2 or 3 or 4 days. It changes its settings from the built-in volatility switch. I'm just going to expand this. You'll all have seen this. I mean, this is the nice stuff that happens when you, let me see if I can get a, here's a spotlight. See if this, here we are. I've actually got this stuff to work for a change. Here's this nice big run up here that went all the way from about the beginning of the month up until the 22nd of the month. That whole trade there was worth about $4,000 per one E-mini. So when you get the runs in these markets, you do make an enormous amount of money. What I wanted to highlight to you, I'll just spread this out a bit so you can see it. Let me find these tools here. I want to spread this out now that you've seen that, to show you what has happened in this other period from about May 22nd down, which is the start of this correction. And you can see that the figures in blue, forget about the bracket. This particular tool at Trade Navigator, let me show you, when you use it in an up way, it gives you a positive number. When you use it pointing down, it gives you a negative number. Which is not terribly sophisticated, but that's how it works. But what I've done is I've put the buy orders in blue for you, and the red orders, the sell orders that failed. I put the successful orders in blue and the failed, the losing trades, in red. And if you just have a look at this from towards the end of May, when these turns started just before Memorial Day, you can see that this has made 13, 14, 15, 15, 6, 16, 1, 17. It's made about $1,300 per one contract, and you certainly hadn't made that much on the daily charts. In fact, some of the daily trading was negative in returns because of the size of the bars. So this is a excuse me, a new product, and we're going to try and deliver it to you in a more modern way. You're not going to have to look at charts. You're not going to have to worry about the analysis that you've had to do until now. it's simply going to give you a buy or sell signal with the appropriate market. And that's going to be delivered to you by cell phone. It's been a real problem being able to deliver this stuff by cell phone because we have clients all over the world, and various telcos decide that that you can only have a certain number of texts or what have you, and there are different protocols for all the different countries. But we do think, Terry tells me, we have solved that problem now, and we expect we're going to start beta testing this next week, and we're expecting that we'll be able to start sending you these signals probably in the third week of this month. So we'll have a week of beta testing, a week of my eyeball testing, and then if we have enough beta people all over the world from different parts of the world, we'll be able to tell you that this stuff is getting to you in a timely manner, and the signals seem to be on our testing at the moment going through sometimes in a minute or less, sometimes 2 or 3 minutes. It's not so time critical that will affect what you're doing, but you can see that this is another tool for you. It's certainly something that is going to keep your equity curve ticking over in times when markets are not trending, and it does capture all of the money when they are trending. So that's going to be a huge thing. So I want to get that across to you, just let you know that's coming while I had your attention. We're going to switch now to the daily DX chart and have a look at this double hook. Now, this is the period up here that we're concerned about. We had 2 hooks. There's one, and let me just highlight that for you. It finished up being a 2-day hook, and that is, if you can't see the dates, that's May the 22nd and May the 23rd. And then we had another hook right here, and that was May the 28th and the 29th. So this is the Memorial Day holiday in here. So we should have had, where we find it, right here. May the 27th was Memorial Day. So let me preface my remarks by saying that trading around public holidays, market holidays, is itself inherently dangerous because the behavior of a lot of the participants changes. Now, Jerry Winters told me this is a very special time for Americans. Winter's over, and things are starting to warm up, and you're getting into spring, and this is a great time to take a break and have your barbecues and what have you. And what we've noticed over the years is that some of these market holidays are more important than others. Memorial Day is one of them because a lot of people will be, a lot of the big traders, the prop traders, the hedge fund managers, etc., will be winding down their trading in the days going into the holiday, and then a lot of them decide that they're going to have a couple of extra days off in the week immediately after Memorial Day. Same for Easter, and there's another one as well. So volume is light, and markets can do things that are more unusual than normal, shall I say. So let's just look at this DX chart. This is a standard at this bar here. This is May the 17th. This is a standard Danielcode sell signal, as described in the manual and various videos and everything else at the site. You had the short term, the faster of the 2 stochastics overbought. You had the slower of the 2 stochastics overbought, and you had divergence on our momentum indicator, which is the CCI. This number here for the CCI was 122, and if you go back here, this is actually the momentum high, May the 10th. So you had this divergence of the market going up and the momentum indicator going down. That's classic divergence, and that sets up, let's get rid of that, that sets up the standard Danielcode sell signal. So we had our sell signal here another bar down. The stochastic's got a ton of room to go down, and then we had this one bar up, which actually took out the highs of the last two bars and stopped us out. Excuse me. Annoyingly, the market then continued its progression and went down. There was no sell signal. There's no sell signal on this chart, which is the basic Danielcode chart. There was no sell signal on GMAG or on the Fractalian. The Fractalian, in fact, had one sell signal which needed qualification to become valid. The tutorial people will know what I'm talking about. I did a tutorial for them recently. And then we had another sell here, inside bar for Memorial Day, which is really not a true bar. It's just reflecting the electronic trading in this market for the few hours that it traded. Then you had this big bar up and another outside bar down. Again, no sell signal for that bar from this chart, which means that you didn't get this nice run down, which this sell actually came in there, and it's worth about $2,100 per one contract at the close today, and you've got to be able to get those trades. They're the trades that make your equity curve, so I'm going to show you how to do that. The secret to this stuff is using the Danielcode trading channels. Now, there's a big video up. If there's some of this stuff that you don't get, please go and have a look under the videos tab at the Danielcode website, which is here, and right at the top you'll see that there's a tab that says articles. You should be reading all of those, and another one saying videos, and these are past webinars that I've done mainly, and in there's one called Danielcode Trading Channels. I'm going to assume that you're going to take the time to go and read that and learn how to do these things, but I was staggered to have one of my tutorial graduates say, I don't know how to create the Danielcode trading channels. And you should, because they're a gem. They're absolute gold, and they give you context for markets, as you're going to see. So to do that, we use this tool over here in the Trade Navigator suite of tools, and they call it Regression Line Channel Best Fit. Now, that does the purpose, but it doesn't actually work in any useful way, and I'll show you why. The way this is constructed, and this is a trading tool that lots of people use, if you start drawing this from any high or low, it will expand and contract largely enough to fit any pattern, and we don't want that. And as well as that, its default setting is one standard deviation, and we don't want that either. This is just a tool that will fit any market pattern you can think of, and it goes on getting bigger and bigger as required, and that tells us exactly nothing. What we want to do, though, is we want to use that tool, but we want to turn it into a Danielcode trading channel, which is quite different. And to create the Danielcode trading channel, we use the same tool. Here's the regression line, and we're going to draw a Danielcode trading channel from the low of the move. It can start from either the low or it can start from the closing low. Remember, everything in the Danielcode works off a bar, high, low, or the close. Both are valid. In this case, we have both the same thing. We have here's our chart low on May the 10th, and we also have, this is also the closing low. So we can confidently draw our Danielcode trading channel from here. And what I want you to do is I want you to watch this top line. Okay, there are two characteristics in here that are different. The first is, click on the heavier blue line, that's called the median, and click the edit button, and you'll see that the standard deviation value is 1.593, and that's the main Danielcode number. The tool, when you get it, and all of these regression channels, is one standard deviation. That is worth, I can tell you, exactly nothing. You have to convert that standard deviation value to a recognizable Danielcode number, the most important of which is 1.593. All futures markets run on 1.593. Those of you who've seen the members charts will know that these markets turn with extraordinary accuracy at the Danielcode numbers which are on the members' charts. And they don't turn anywhere else. And to test that proposition, at the top of the website, we've got the archive of all the charts that I've created for the last few years, and there's some thousands of charts in there. And if you take the time and effort to go through those, remember, give it plenty of time to open. It's a massive file. There are thousands of charts in there. You will soon join me in the view that markets do not turn anywhere except at a Danielcode number, which is why those charts themselves are gold and should be the basis of your trading. Regrettably, they're not. Most people don't take the time to put those numbers onto their charts. They're published twice a week, the members' charts, and if you're not getting those, you're missing a great opportunity, because if you can say with certainty that market do not turn except at Danielcode numbers, then it follows you want those numbers on your chart. Looking at this trading channel here, we're trying to turn it from a regression channel into a Danielcode trading channel. So we changed the standard deviation number in here to 1.593. Down below here, the default of this study is a dynamic stay at the end of the visible data, and that means that if that is ticked, which is the default setting, the channel will go on extending itself every day as it gets a new daily bar or a new 6-day bar or whatever you're using. You don't want that, because it's a lazy man's way of doing things, and it will finish up breaching the validity of the Danielcode trading channel. So make sure that dynamic stay at the end of visible data is not ticked, and then save that as your default. The reason for that is that to be a valid Danielcode trading channel, if it is trending up, that is, if it is rising, it has to have contact with 2 points in the chart. And when it loses that contact, it is no longer a valid trading channel. It's simply a regression line. And then that stops giving us the information that we want, which I'm going to show you. So we have contact with this first bar here. This is 0503, and we want to keep that contact. We need, as these charts build up and move along, you'll often get other points of contact. But those of you who've had anything to do with building and drawing straight lines, you don't want two pivots close together. You need them, excuse me, spread out over a distance. The further apart, the better. And this one, the first counter trend out of the turn, is particularly valuable. And I need a lot of, I need to be convinced, was the word I was looking for, that I would have a trading channel that had lost that first counter trend, high or low. So if the Danielcode channel is sloping up, you must have contact with 2 points in the chart. If it's trending down, which I'm going to show you as well, you must have contact with the 2 points at the bottom side of the chart. So this is what happens. We'll move this along. I want you to keep your eye on this bar here, 503, and because when we lose contact with that, we can't go any further. So here's your Danielcode trading channel. These things are quite extraordinary. Very often when in trending markets, they will set up in a matter of 8 or 10 bars what's going to happen for the next 2 or 3 months. So we're still valid because we've still got this contact here. And as we move along, you'll see that the upper one Danielcode standard deviation, which is 1.593, is starting to move higher. We still have contact with this bar here, and we've got good contact up here, so this is still a valid Danielcode trading channel. Look what's happened now. We've moved one more bar, and this has flicked away, and it's lost its contact with this high bar here. Now, we have contact here, though. We have contact at this bar, 510. The next one, that's 2, that's then 3. And we have contact at 4 places. And we have a close on the high of this Danielcode trading channel, which tells us that the market knows what this trading channel is and it's following it. And that's what it does all the time. All right, so as we move on further, we've now lost contact with this intermediate point at 510. we've now only got contact with the two bars and they're very close together. That is no longer a valid Danielcode trading channel. That is simply a regression channel, which is no use to us. So we back it off down, and we now have where we were a minute ago. We've lost contact with these two initial ones, but we've got contact in 1, 2, 3, 4 places. We've got a bit of spread across the various bars, and we've got very, very good channel recognition on this bar, which is closed at the top of the Danielcode trading channel. If you wanted to back this off and keep the contact with the earlier bar, it's just a question of doing that. Now, this is about 90% science and 10% art. The more you put these trading channels on your charts, the better you'll become at it. There's a fairly reasonably new member we have in London, John P., who only has been with us a matter of months, maybe 6 or 7 months, and he's become an absolute whiz at this because he's made it his passion to put trading channels on all of his charts. It is an invaluable tool. I went so far at the last webinar, the last tutorial group in Las Vegas, to say the first thing you should put on your charts are these trading channels, and you should update them every day. And it gives you context of what the market's doing, and it sets up the best of the buy and sell points. So I've already told you there was no sell signal. This was the last sell signal here. Let me see if I can put something on there to make that clear. That was your last valid sell signal, Danielcode sell signal, which was also a CTP signal for the GMAG guys and a Fraxen signal for the tutorial guys. So down it goes up, stops you out, and there's no sell signal there. Then we get a bar down, a little bar, and we get these two bars up here. Now, this is how markets fail. When they fall out of the trading channel, they go to, that was one channel. We can change this and make it 2 channels. And what markets do after they've fallen out of the first channel, they go to the second channel, and from there they try to recover the mean, that's this darker blue line, and get back into the channel. And that's what this looked like here. You had your sell signal going down, you had this rally back up which closed right at the mean, it went down again, your next sell took you right down to the lower of 2 channels. We don't allow it to go any further than that. If it breaks out of that, we've got a trend change. But let me just go back to where we were here to show you, now you understand, this is how markets change trend. And if we go back to our one channel, so I don't make this whole chart too messy for you, this is what you've got. We're looking for the market. It's broken out of its Danielcode trading channel. We expect it to try and regain that channel. And here it is. Look at this bar here. The ES is even better. Where it's rallied to is just a couple of ticks away from the bottom of this Danielcode trading channel. Now, we think that that's going to continue to go up and it's going to get back into its trading channel. But if it fails there, you're going to likely get a fast move down. And this is the hook. This is the hook trade. And it comes about from this method here, that once you have your sell signal in place, this is your Danielcode sell signal right here, you will then look and say, as long as the market, and there are 2 ways of it overcoming, I don't know if you can see that black line, I'll make it just a little bit thicker for you. You should be able to see it now. That's the failure point for the sell signal. And it can fail 2 ways. It can either fail by taking out the high, or it can fail by closing above the close. Now, you'll see that this rally here went to the median of the trading channel, and it did not close above the close of this bar, so that sell is still valid. It's still telling you that the dominant trend is probably down. Then we get this false break here. Now, this is where it gets complex. The high of our setup bar for the sell was 84,515. The high of this was 84,595. In other words, it took out the high on an intraday basis and failed straight away. If you wanted to make your trading perfect, you could do it by switching to signals on close. Everything in the Danielcode is either valid on the bar, high, low, or the close. And if you turn your chart into a close-only chart, which is this little icon up here, you'll see here's our sell signal failure line. The market never ever approached it, but it did do it on an intraday basis, which was annoying enough because the reality is this bar had already stopped you out. But the point I'm trying to make is once you have this bar in place, any price action underneath here has a default bias of being a sell. And the most common thing that these markets do is they'll go back to retest that signal, retest the high, and that is how the Elliott waves get their 1-2 for the Elliott wave count. That, as far as I know, is the only part of Elliott wave theory that's actually valid. But we call that the hook, and the hook trade is probably the best trade we have. Because everyone's on the wrong side of the trade, which is what the market wants to do before it moves away. So let's get rid of this so I'm not confusing you. And this is what we're looking at here, this second hook. And because this was a valid buy signal here for 0528, so you were long and expecting this market to recover its trend channel and just keep on trucking up. But because it set up the hook, you've got a rally below the high and below the close of the original sell signal, which is way back here on 517. If you get a sell, then it's a breakout or it's a hook trade, and they give us the very best trades that we have by and large. And as you can see, being aware of that being a hook trade has just in the last, is it 1, 2, 3, 4, the last 7 days, 1, 2, 3, 4, 5, the last 6 trading days, it's given you over $2,000 per one contract in this marvelous market. So that's the hook trade, and you need to learn and understand that. I want to show you another example. Remember the things I've shown you here. How to create a valid Danielcode trading channel. It has to have contact with 2 points if it's trending up and 2 points if it's trending down. So we can now, before I finish here, we can get rid of that trading channel, and we can put on the new one because we've had a trend change there, and we can draw the downward trending channel either from this bar, which is 0523, which is the chart high, or we can draw it from back here on 517, which is the closing high. Both are valid. So let's draw it from here first of all, and I have my regression channel tool set. The default setting is 1.593, so that's fine. This dynamic stay is not ticked, so it won't move along automatically every day, so I need to look at these charts every day and drag it along one period and then say, is this still a valid trading channel? Well, you can see that we've got contact with this counter trend bar here, and we've got contract good few bars apart, so this is a valid Danielcode trading channel. We can move on to there. Now we've lost it. Let me do that again. Just watch this bottom blue line along here where you see my cursor moving. If I move this trading channel along one period, it's going to jump away from this contact it has with this bar and this bar. At the moment we have contact with it on 520, 522, and 603. So we've got a valid Danielcode trading channel. This is a downward sloping DC trading channel, so it must maintain the contact at those 2 points with the great urgency being on contact at this first move out the counter trend. Let me tell you, sometimes it doesn't set up that way. The charts just don't move in a way that you can put a Danielcode trading channel on it, in which case you'll put the closest thing you can, which will be an invalid Danielcode trading channel. It's not as definitive as what I'm telling you now, but when that happens, you'll still find it immensely useful. So this is your first task every day as traders. Now watch what happens up here with this blue line, which is the one standard Danielcode standard deviation from the mean as I move this along now. One more bar for today. It's moved. We've lost contact. There's no contact with any of these bars here. In fact, all you've got is contact with the top of this, bottom of this bar, which is how it's constructed, and down here. So this is no longer a valid trading channel. When that happens, you just back it off to the last position where it was a valid trading channel, and we now are interested here in moving to our 2 channel, and this in fact looks to me like it's about 3 or 4. It's a very, very big move down. Don't forget also, have a look at these charts. Have a look particularly with this light blue symbol you see here, which has an R, letter R for Robert inside it, which tells you that's the date that we anticipate these markets are going to roll to the new contract. So make sure you're out of this market 2 or 3 days, 3 days preferably before that date, and into the new contract. Okay, so that's taken us 45 minutes. I want to show you the same thing in the E-mini trade, because I know that most of you trade that market, and it will be helpful for you to see how that's set up. So here we are. We've got the same thing. This is the E-mini. This is our Memorial Day weekend in here. We got some funny stuff, but no matter how funny, markets can't really move without giving us a signal. When they do, it's just our lack of knowledge that we didn't see it at the time. So let's do the same thing. Here's our low for the run-up. This is the 4th of April, April the 18th. And our chart low is also our closing low, so we can confidently start our Danielcode regression channel from there. You keep an eye on the top of this. We need to have contact at 2 points. We move along, and there we've lost it. So we start off with contact at the top of this bar, 0423. As we moved on, we still have contact with the top of this bar, 0425, and we have contact further up. Well, big space between the bars, which is great, on 0515. Keep an eye on this point here. I'll put a circle on it so you can see it more clearly. It's the high of this bar in contact with the trading channel that we're concerned with. If we move this on one more bar, it's lost it. Okay, it has contact there. That is a valid Danielcode trading channel. Now it's lost it. That is no longer a valid Danielcode trading channel. And there's not much to argue about there. So if we back that down to where the last time it was valid, it's right there. Let me take this circle off. That's not what I want to take off. These little circles are hard to get off once you put them on, which is why I don't use them terribly often. We can put our regression channel back on straight away. That's only a click and a draw, and we got that far before we lost it. So this is a valid Danielcode trading channel. It has the contact of the 2 points. This market, there was your sell signal right up here. This is slightly different to the DX. So this is your sell signal here. We have the short-term stochastic overbought. We have the long-term stochastic overbought. We have the momentum falling away. In other words, the market's made a new high on this day, 521, and momentum hasn't. Momentum has made a lesser high. And that's the setup for a standard Danielcode trading signal, which tells us to sell the next day, which we do. And there's our sell, and down it goes. Now, we get into Memorial Day. Here's the Friday before Memorial Day. Everyone's gone on holiday. Everyone who counts has gone on holiday. And there's not enough volatility to create anything except an inside bar. Then we get this little up bar here. There was a buy signal from 523. We got an inside bar, so we carry it forward. The buy signal was technically elected, but we didn't get filled because we have that 2-tick buffer on our futures, 5-tick buffer, don't forget, in Forex. But then you have to acknowledge that the market has created that signal and buy it the next day, which we did. And here it goes, and we expect this market trend there is up. The stochastic's telling us that it's gone down and then turned, but there is no new sell signal there from the Danielcode suite of signals or from GMAG or from the Fractalian suite. In fact, The only way you could have known there was a sell there is if you'd got the GMAX Pro signal. I posted that as a sell. This next day was a buy, which was unsatisfactory, and then we got the sell, and we finally got it moving away a bit. But all through here, we lost money on these trades because of the size of the daily bars and our stops. And opposed to that, you will recall I showed you what FracZen was doing through that period, which was making money for us almost every day. So let's go back here, and here's the hook trade. This was our last valid sell, so we know that if the market rallies below this point here, I'll make that a little thicker for you, if the market rallies below that point there, it's going to set up the hook trade. And the hook trade, I repeat, is the most likely the most valuable of our standard signals. If you get this stuff right, the hook trade usually precedes a decent move. So this rally in here, why would you sell it? Because it's failing at the Danielcode trading channel, and if you didn't have your trading channel on this, you just had no clue. So yes, part of this issue, this problem, was because of choppy market, is because it was in the holiday period, and there weren't a lot of big volume in here. So markets do funny things, but look, you can see where it went. It rallied straight into that lower median of the bottom of the DC trading channel. Our assumption was it'll do what these markets always do, try and regain the channel once it's broken out of it. But if it doesn't, if it fails there, you're going to get a decent move down. And that's what created this sell signal here. And then, as you can see, this has been fairly choppy all through here. But if you had FracZen running either with it, alongside it, or as a standalone trading program, you certainly made a good lot of money out of there. Folks, we've been going for 8 minutes short of an hour. I don't want to overdo this because I know that you, most of you have other arrangements. So let me quickly run through the questions so we have a little time to talk about that. Sita, hi to you, and D. I wonder who D is. Good evening, John D. I don't know who that is. I do not see any movement on the screen. I think I got that going. Someone's saying there seems to be an issue. Can't see the cursor move. Oh, they've got it now. How do I define a double hook? The double hook is what you're seeing over here. It's any rally underneath the last in this case, it's a Danielcode sell signal. Thanks, Terry. I'm just getting a message from Terry here. So any signal after you've got your last valid Danielcode signal, any rally underneath it can potentially set up a hook trade, but you need more than that. There are two things that you'll usually see here. This is the most important thing that you'll see, the rally into the bottom of the Danielcode trading channel. And the other thing you will see is that if you put on your Danielcode retracement tool, which is this one here, it's the little one that's got the hedgehog on it, which you can see down here. That's down the hedgehog. These rallies, if they're valid, will always, and I don't use that word very often, but they will always go to one of the Danielcode retracements. Those of you who haven't been with us before may not know that these Danielcode red and blue lines that are created from the tools and from the members charts are not Fibonacci numbers. They're not even a cousin of Fibonacci numbers. They are a proprietary ratio that governs all markets in all time frames, and I invented them about in a periodic time period. You know, you think you get these revelations and great discoveries. I started working with this stuff probably 20 years ago or more now, and didn't, and I'm still learning. But the other characteristic of the hook is it will always, let's say 99.9%, there's no such thing as always in trading, it will nearly always, very high percentage, go to a recognizable Danielcode number on the retracements. So if you haven't got this tool here, this is this little guy Dan, and he will tell you where these markets are going to go. on a big time frame or a little time frame all the time, and you can tell from this tool which part of the market is actually being corrected. This move down so far, as you just saw, is not correcting this whole swing. It's probably correcting the penultimate swing, which will be down to here. That's the swing before the final swing. And that gives you some very good insights into the intensity of the move. I'm just going to stop the recording at the moment, folks, so that